You called the top in this sector last year. Walk me through where you think we are now.
Well, I think we're in the retest phase of those December lows. I started shorting bank stocks a couple of weeks ago around the time of the J.P. Morgan Investor Day, and what they projected was a slowing in net interest income growth. And the Fed kind of cemented that view with their policy changes the other day.
Even some of the bulls predicted, Charlie, that we wouldn't get the net interest margin growth in the way that we were getting it. They were hoping it would be offset by volume. Are you saying that's not going to happen?
Well, I think there will be a push for volume, in an effort to offset the pressure on net interest margins. But this is where the mistakes are made for the next recession. So I think it's going to be bad volume, if you will. The other thing I don't think the analyst community appreciates is what's going on in the Treasury yield curve. I mean, the Fed essentially went from being a net buyer of Treasuries to a net issuer of Treasuries, and there's about a $500 billion swing in that equation. So it's going to put significant pressure on the belly of the curve. In addition, banks are going to scramble to reduce their asset sensitivity, so they're going to continue to buy the 2 to 5s. And then, if QT continues through September, as it will, you're going to see a further drain of excess reserves. So I think all of those things are going to conspire to pressure the yield curve, and I think we'll see the 2s, 5s trade below the lower end of the effective Fed funds rate.
So, Charles, let's talk about what would happen if we continue to get this inversion at the front end of the curve. We had it last week, 3-month versus 10-year. I'm still trying to understand the relationship between that and the net interest margin. Hasn't it changed somewhat, given the fact that many of the deposits on hold at these banks now offer 0% interest? The deposit beta has remained remarkably low, and despite the curve flattening over the last couple of years, the net interest margins actually continue to grow.
Well, I think you're looking at one half of the equation. Personally, I think deposit betas will continue to rise, albeit more slowly. The other half is what's happening with the loan betas. If you look at 1-month, 3-month, or 6-month LIBOR has been coming down since January. So the loan beta has been a detriment to margins.